But I think it's always interesting when any governor in the Fed gives comment on policy. They don't do that lightly. They've thought it through, they've vetted it, they've discussed internally and all those things that they do. We all know the Fed doesn't say anything that might shake markets.
The Weekly Friedman, your source for the most essential information in the default industry, with your host, Adam Friedman.
In a prior episode, we discussed federal comments regarding MSR capital rules, and today I'm joined by Friedman Vartolo, Director of Client Relations, Michael Chisholm, to discuss the market impact. Mike, part of the reason I was excited to do this episode is that I feel like this is a complicated topic. What's going on? What does this mean? What are we talking about?
So the comments from this vice chair were interesting because the perspective here is that after the financial crisis, a lot of requirements were put on banks to manage their capital properly and make sure we didn't have another 2008. And there was a long-term impact that wasn't probably really foreseen, which was it really shifted banks who are making the loan with the borrower out of the business of servicing. So from 2008, and this is data put out by MBA, from 2008 to 2025, depository servicing volume based on loan count went from 90% to 39%. And independent servicers went from 10% in 2008 to 62% in 2025. So it looks like the Fed's idea, and in the broader context of affordable housing, is bring back the community feel of banking, maybe reduce some costs for borrower where you're paying out for sub-servicing operations, and create an environment where banks could re-enter based on easing the capital restrictions, the capital rules, Set 1 and Basel III, easing those so that banks could re-enter the servicing space and create more community and borrower relationship.
It almost sounds easy, right? If you change these rules, banks jump back in. Do you think it's that easy?
So that's the big question. I think there's a few factors that are really interesting here. One is, if you've been in the industry for as long as we've been in, you remember the days of major banking institutions having their huge mortgage servicing centers. Thousands of people working in call centers, working in loss mitigation, working on loan review, et cetera, et cetera. I think one of the biggest questions when you look at this change in policy is, could it impact the market? Sure. And by the market, we mean who's servicing loans, right? The reality is, there's a big cost to reestablishing these operations. How much investment and capital does it make sense to put in to offset sub-servicing costs? Another question is, there's always the risk of policy change again. The government did this once, they could do it again. Does that put too much fear into banking institutions to wholeheartedly jump in? I think probably there's a middle ground where you retain more servicing rights than you did prior. But the future's unclear. So it would really come down to cost and appetite of the risk of another government policy change. And I think another big factor that hangs over the head of this is, what does AI do in the coming years? How does that change the cost of running a servicing operation? So a lot of gray areas, I think.
Do you feel like anything is imminent, or is this speculation? Everyone's in the wait and see stage where they're evaluating.
I think it's always interesting when any governor in the Fed gives comment on policy. They don't do that lightly. They've thought it through, they've vetted it, they've discussed internally and all those things that they do. We all know the Fed doesn't say anything that might shake markets. So I think by the outline of their thoughts on this, at least presented in this one speech, there's got to be some movement on potential policy change. If that happens, you're probably still years away from seeing the impacts of easing these restrictions. I think that really there's so much uncertainty right now in the changing in the technology of the world in general and the housing market that together it probably makes it unclear on timeline. So it could be 5 years, it could be 2 years that you see an impact. But does this shift back to pre-financial crisis levels? I don't see it, but it could happen.
Mike, I appreciate it. Interesting topic, very valuable insight. Thanks for joining Michael Chisholm and I on the Weekly Friedman, your source for the most essential information in the default industry. Thanks for tuning in and looking forward to seeing you next time.